Welcome back to the Deep Dive. Today, we are plunging into a world that, well, it's fundamentally changed, the world of real estate.
It really has.
For generations, success in property was, based on intuition, local knowledge, maybe a little bit of gut feeling.
Hmm.
But that era, it's rapidly fading.
Oh, definitely.
We are now living in the age of data-driven real estate, where property values and market movements are less art, much more science. It's driven by systematic analysis, big data, and some pretty powerful algorithms.
That's the core shift, absolutely. And it's why understanding this modern landscape is so crucial for anyone involved, really. Our mission today is to give you, the listener, a kind of blueprint for the competitive advantage now.
Okay.
We've synthesized sources that really pull back the curtain on everything from the high-level quantitative formulas used by big institutional investors, all the way down to some surprising historical, even sociological data points that, believe it or not, still dictate market risk and value today.
So we're looking at how all this knowledge, this big data, is synthesized to make powerful decisions.
Yeah.
And often decisions made without the investor ever actually, stepping foot on the property.
That's a huge part of it, yeah. The ability to operate remotely based on solid data.
Okay, let's unpack this. Let's dive right in, starting with Section 1, the PropTech transformation and operational efficiency.
Great place to start. The first observation our sources highlighted is about the unique history of innovation in this sector. Real estate, especially when you compare it to industries like finance or retail, it managed to insulate itself from technological advancements for much, much longer.
Right, they really clung to the handshake deal, the paper file, that old way of doing things.
Exactly. And what that insulation created was this, well, massive pent-up demand for efficiency. Now that technology is truly breaking through what we generally call prop tech, the pace of change is just accelerating incredibly rapidly.
It's like a compressed learning curve for everyone involved, isn't it?
Absolutely. And this acceleration, it's directly responsible for changing how deals are even sourced and acquired in the first place. There are new data systems, new resources available today for buying real estate that, frankly, were just unavailable previously.
We're talking about systems that allow for pretty sophisticated remote investment, right? Long-distance strategies that kind of redefine what being a local market expert even means.
Precisely. Expertise now is much more about data aggregation, about analysis, not just physical proximity.
And this is what's fueling the expansion of the virtual business model in real estate, especially in areas like wholesaling, maybe.
That's a prime example. Wholesaling, where investors contract a property and then just assign that contract, often without ever taking ownership or, like you said, even seeing the inside of the place.
So how does data make that possible at scale?
Well, this is where it gets really disruptive. Our sources point to a, frankly, surprising finding. With the sheer wealth of information and data available online now, I mean, we're talking aggregated comp sales data, granular tax assessments, detailed satellite imagery, utility records, neighborhood demographics, even things like court records on foreclosures and permits.
Wow.
Investors can make, and this is the key part, fairly accurate offers on up to, wait for it, 95% of properties.
95%.
95%. Without ever personally setting foot inside or even driving by.
That number is massive. It suggests that if you have access to the right data streams, the right analytical tools, just being nearby is, well, it's almost irrelevant for proficiency now.
It's becoming less and less relevant, yeah. You're no longer constrained to invest only where it's convenient for you or close or comfortable. You can invest where the quantitative data, the big data, shows it makes the most sense for your specific financial situation.
Even if that means using long-distance strategies.
Exactly, that virtual capability. It's entirely powered by this prop tech ecosystem. When we try to categorize prop tech, we usually break it down by the type of technology being introduced.
Okay.
First, you've got software. This is the core, right? The complex algorithms, the programs investors use for automated CMAs, comparative market analyses, lead generation, underwriting deals, managing portfolios.
All the number crunching and analysis tools.
Yeah. Right. Second, there's hardware. Think smart building sensors, remote access monitoring systems, drone imagery for, rapid inspections, or tracking construction progress from afar.
Okay, physical tech interacting with the property.
Correct. And the third category is what we call tech-enabled services. These are platforms and tools that allow people to utilize and monetize previously underused assets, often optimizing operational efficiency.
Like platforms for managing short-term rentals, maybe. Or specialized co-working space management.
Exactly. Things that help squeeze more value out of the physical asset using technology as the facilitator.
And the crucial point here, I guess, is that These three types of tech, working together, allow firms to sort of see around corners, to predict local market shifts maybe sooner than the public data reflects.
That's the edge, yes. They can use AI-driven analysis of things like social media sentiment, tracking construction permit applications, even monitoring migration patterns from aggregated, anonymized data.
To forecast gentrification maybe, or market slowdowns before the listing prices actually start to move.
Precisely. It gives them a time advantage.
Now that sounds incredibly efficient, obviously, but I have to push back just a little here. If these data streams are becoming more standardized and, 95% of the initial analysis can be done remotely, doesn't that massive efficiency advantage also kind of create a race to the bottom, where everyone has the same data, competition skyrockets, and margins get squeezed?
That's an excellent point. And, well, the short answer is yes, it definitely increases competition. But what it also does is raise the bar significantly for operational excellence. The tech provides the tools, absolutely, but the investor still needs the system.
Why?
It can't just be a scattershot approach where you download a report and hope for the best. This is why the really successful investors, the ones thriving in this data age, adhere rigidly to a systematic approach. They move away from that anxious, white-knuckled hope and prayer investing.
It's the difference between having a computer and knowing how to program it, essentially. You need a process, a methodology.
Precisely. The whole mentality has to shift. You can't be a passive gardener anymore. Plant a seed, walk away for 30 years, hope it grows. You have to be more like a diligent farmer, constantly tracking every variable.
Studying what asset class to grow, where to grow it, hiring the right people to manage the operations.
All of it. This is why successful investors relentlessly systemize their processes. The famous example, of course, is the BRRRR method: buy, rehab, rent, refinance, repeat.
Let's just quickly define BRRRR for listeners who might not be familiar with that acronym.
Sure. BRRR is really a technique focused on recycling your capital efficiently. You buy a distressed asset, usually below market value. You rehab it quickly to force appreciation and increase its value. You rent it out to establish a dependable income stream. Then, critically, you refinance it, pulling cash out based on the new, higher appraised value. And that pulled out cash allows you to repeat the cycle on the next deal.
So the systemization of BRRR means that once you master it, the whole process feels almost effortless, repeatable. You're focused on the business machine, not the anxiety of one single transaction.
That's exactly it. That systematic mindset driven by data and process is what truly separates the winners in this data-driven age. It's about building a scalable business based on measurable rules, not just relying on individual genius or, chasing hot tips.
Okay, that makes sense. Let's move into section 2 then. Quantifying value. Formulas and financial data analysis. This is where we get into the actual numerical science behind it all.
Right, the nitty-gritty numbers.
The competitive advantage today, it seems, really comes from understanding how properties are valued using these standardized financial metrics. Mastering this lets you, accurately maximize a property's worth and just make better financial decisions overall.
And the core goal, especially for investors using systems like BRRR we just talked about, is always buying deals measurably under market value. That's where the profit is often made on the purchase.
And to do that consistently, you absolutely have to move beyond just intuition or gut feeling. You need to apply strict quantitative metrics. Where do we start?
The first key metric, really foundational in commercial real estate and very often applied to multifamily residential too, is the capitalization rate, or cap rate.
Okay, cap rate. What does it tell us?
In simple terms, the cap rate tells you the projected rate of return you could expect if you bought the asset entirely with cash, meaning no debt involved.
So it's a pure measure of the property's income-generating power relative to its cost.
Exactly, and the calculation itself is pretty straightforward, but its meaning is quite profound for valuation. The basic formula is net operating income, NOI. That's your income after operating expenses, but before debt service divided by the appropriate cap rate for that market and property type equals the property value.
Okay, so NOI divided by cap rate equals value. Let's use an example.
Sure. Let's say a property generates $100,000 in net operating income per year. And let's say the market average cap rate for that kind of property in that specific location is 5% or
Right.
0.05.
Right.
You take $100,000 NOI, divide it by 0.05, and you get a market value of $2 million.
Okay, simple enough. But that formula also reveals a really crucial inverse relationship, doesn't it, between the cap rate and the value?
Absolutely critical to understand this. A higher cap rate actually translates to a lower current property value. Why? because the market is essentially saying it requires a higher rate of return to compensate for perceived higher risk or perhaps slower future growth in that asset or area.
So higher risk, higher cap rate, lower price today.
Correct. Conversely, a lower cap rate means the market is assigning a significantly higher value to that property's income stream. This usually reflects perceived stability, maybe rapid rent growth expectations, or a premium location.
So lower risk, lower cap rate, higher price today. Investors must be constantly tracking these cap rate trends then, because they signal where the market sees risk versus safety.
Constantly, it's a fundamental barometer of market sentiment for income properties. Okay, next up is the cash-on-cash return.
All right. How's this different from cap rate?
Well, while the cap rate ignores debt entirely, cash-on-cash is vital because it measures the annual return relative to the actual cash you invested out of pocket after accounting for your loan payments.
So this is much more relevant to the individual investor using leverage, using loans. It's about the return on their money specifically.
Exactly. It's a critical liquidity metric for measuring your personal performance on a deal. Think of it as the practical acid test.
So how do you calculate it?
You take the annual pre-tax cash flow, which is your NOI minus your annual debt service, principal and interest payments, and you divide that number by the total cash you initially invested. That includes your down payment, all your closing costs, and any immediate rehab capital you put in.
And the key discipline here is...
The key discipline is that investors must run this calculation before finalizing any offer. You have to set a minimum acceptable return for yourself. Maybe it's 10%, maybe 12%, whatever your threshold is. If the calculation shows the deal falls below that minimum,
it's a no-go. The data has to rule the decision, not the emotion of wanting the deal.
precisely. Especially when you're operating virtually on maybe 95% of these potential deals, relying heavily on the data, you need those hard rules.
It makes sense. Okay, and finally in this group, let's clarify the loan constant. This one seems to get confused sometimes with just the basic interest rate.
It does, and it's an important distinction. The loan constant gives you a more truthful picture of the annual cost of your debt. The formula is your total annual debt service divided by the original loan amount.
And the crucial difference from the interest rate is that annual debt service includes both principal and interest payments.
Right. Exactly. It's not just the interest you're paying, it's the total percentage of the original loan amount that you have to pay back every single year just to service that debt.
So even though we use an interest rate to calculate the monthly payment,
Right, but the loan constant reflects the all-in real percentage cost you pay annually. And because it includes that principal reduction component, this number is, well, virtually always larger than the actual interest rate the bank quotes you.
understanding that difference seems vital for accurately modeling your long-term cash flow and the true cost of borrowing, not just the headline interest rate.
It absolutely is. It prevents nasty surprises down the line.
Okay, so once you've got those core quantitative metrics nailed down, cap rate, cash on cash, loan constant, sophisticated investors, then introduce a tool that's really all about predictive data modeling and mitigating risk. This is sensitivity analysis.
Yes, this is where you start moving from basic metrics to, let's call it, black belt investment modeling. Sensitivity analysis is essentially a rigorous, quantified simulation of risk.
Like a stress test for your deal.
Exactly. You use these tables, these analyses, to model your projected returns, often looking at the internal rate of return, or IRR, under various different alternative performance scenarios. It's the what-if game, but quantified, to really pressure test an investment decision before you commit.
Can you walk us through the key variables you typically see in a sensitivity analysis? What are the critical components you absolutely have to stress test?
Sure, the tables can get incredibly granular, obviously, but the core variables you almost always examine are: first, different exit cap rates. What happens to your profit if the market shifts when you plan to sell? What if you have to sell at a 7% cap rate instead of the 5.5% you projected in your initial model?
Okay, so exit market conditions. What else?
Second, income variance. You model what happens if your rental income doesn't meet projections. What if rents decrease by 5% or 10% due to market conditions? How does that impact your overall return?
Makes sense.
Income risk. Third, vacancy rate variance. What if the building runs at 15% vacant instead of the conservative 5% you underwrote? How much does that higher vacancy eat into your returns over the holding period?
And I imagine the best analysis is start combining these factors.
Oh, absolutely. The really sophisticated models show combinations. For instance, what happens if you have a 10% cost overrun during your rehab and the exit cap rate is 50 basis points higher than you hoped for? The sensitivity table lets the investor see exactly how far off the rails the deal can potentially go before it actually fails to meet their minimum return threshold.
So it helps you build in resilience to structure the deal so it can withstand foreseeable challenges.
Precisely. It moves your investment decision away from relying on a single, often optimistic projection toward understanding a whole range of possible outcomes. For example, if your analysis shows that if construction costs exceed budget by 10%, you'd need an exit cap rate of, say, 4.0% just to hit your minimum required IRR.
And current market cap rates are closer to
Well,
6.0%.
you know immediately that the deal is probably too risky. It doesn't have enough cushion for error based on current market conditions. The sensitivity analysis flags that vulnerability up front.
Okay, and connecting this kind of financial modeling back to market prediction.
Yeah.
The sources suggest the best indicator of future appreciation isn't just reading today's headlines or getting caught up in market hype.
No, not for sophisticated investors. They look deeper. They try to determine where a property or market segment currently sits in the broader economic cycle. And how do they do that? Often by identifying patterns in past recessionary cycles.
Looking back at 2008 or maybe the early 90s recession.
Exactly. They analyze how a specific asset class or a particular geographic location performed during those major downturns. Did rents plummet? Did vacancies spike? Did values hold relatively firm?
So a deal or an asset class that actually survived a past recession, maybe even just broke even during the worst of it.
That demonstrates incredible underlying strength and resilience. That historical performance data becomes a powerful predictor of how it might perform in a future downturn. It's a much more reliable indicator than just current optimism.
Fascinating. Okay, let's shift focus slightly from the pure financial numbers back to the physical product, the house or building itself. Big data and analysis also drive maximizing the sale price through effective staging and managing appearance. Right. This sounds like where finance meets psychology.
It absolutely is. Staging, at its core, is marketing. And effective marketing always starts with data about your target customer. You need to make that house appealing to the greatest number of prospective buyers within your likely pool.
And that requires knowing who that pool is through demographic data. You can't stage a house the same way if you're targeting, say, downsizing baby boomers versus first-time millennial buyers, can you?
Definitely not. You have to segment the market. Baby boomers, for instance, the data shows they often prioritize low-maintenance features, maybe main-floor living options, and proximity to healthcare facilities.
Okay, what about younger generations?
Generation Y, millennials, often prioritize things like smart home technology integration, energy efficiency is usually big, and often proximity to vibrant, walkable, mixed-use areas. Generation X buyers, who are often in their peak earning years, might look for higher quality finishes, dedicated home office space, especially now, and critically, proximity to highly rated schools is often a major factor.
So the demographic data literally dictates the staging choices, the
Yeah.
furniture style, the features you highlight, even the paint colors sometimes.
Absolutely. And we have specific, actionable data points from the sources about things that influence measurable value perception. For curb appeal, for example, maintaining driveways is surprisingly crucial.
Just patching cracks or resealing.
Yes. Data suggests buyers make an almost instantaneous judgment based on curb appeal, and cracked, neglected asphalt can signal potential deferred maintenance inside, even if it's not true. It creates a negative first impression.
Okay, what about inside?
Internally, decluttering high-traffic entry areas is key. Specifically, mudrooms and vestibules. These are the first interior spaces buyers experience, and they form an instant impression about the home's organization and, importantly, storage capacity.
You want them to feel like there's plenty of storage and zero clutter, making the house feel bigger and more functional.
Exactly. And then in staging larger rooms, adjusting furniture placement to improve sightlines and flow is essential. There's even data on this.
Like what?
Well, aesthetic data dictates that furniture should facilitate easy movement and conversation. For example, a sofa ideally shouldn't take up more than about 2/3 of the wall it sits against. A coffee table should be maybe no more than 2/3 the length of the sofa, positioned close enough to be easily used but far enough away to allow natural movement around it.
These sound like small details, but they're measurable data points aimed at creating a positive psychological experience for the buyer.
Precisely. And that positive psychological experience translates directly into a willingness to pay more, leading to a higher bid price. It's data optimizing the emotional response.
This takes us nicely into Section 3, Societal Data and Structural Influences on Market Value. Here we're moving into a deeper dive, looking at the structural and societal data patterns that have historically shaped and frankly continue to influence property risk and value.
Right. This is where we connect those macro patterns, sometimes decades old, to micro-level decisions and valuations happening today. And we really have to start with the legacy of historical segregation and how risk itself was measured and codified based on race.
This is the concept of redlining, linked to the federal government's actions in the past.
Yes, it's necessary context because this legacy of data collection is still deeply embedded in our markets. We have to discuss the historical role of the federal government, specifically the Homeowners Loan Corporation, HOLC, which in the 1930s assessed mortgage risk. And a primary factor in that assessment was race.
The HOLC maps, they were designed to guide investment by measuring future stability and mortgage risk.
Correct. And those maps explicitly used racial homogeneity as a primary positive factor. The federal government essentially went on record using institutional data collection, judging that African Americans, simply because of their race, represented a poor financial risk.
The sources provided some really stark examples of this, didn't they?
They did. In St. Louis, for instance, the white middle-class suburb of Ladue was colored green on the HOLC map that was the highest rating, lowest risk. Why? The official report noted it had, quote, not a single foreigner or Negro, yet a nearby, similarly middle-class area, Lincoln Terrace, was colored red, meaning highest risk, effectively uninsurable, explicitly due to the, quote, colored element now controlling the district. The judgment wasn't about income or property condition. It was purely race being used as a proxy for financial risk.
And when FHA officials were later challenged on this practice?
Their stance, according to the sources, was essentially that they had no responsibility for a social policy. Their mandate was only business risk assessment. And in their view, an interracial community inherently constituted a bad risk and was therefore uninsurable under their guidelines.
So this institutional use of racial data embedded segregation directly into financial models and lending practices for decades.
Absolutely. And it created profound, lasting disparities in wealth accumulation, particularly through homeownership, the effects of which are still very visible in market data today.
What's the immediate connection for, say, a modern investor using big data tools today? How does this history still play out?
Well, the lines drawn on those maps decades ago often still correlate, depressingly, with things like differential municipal services, disparities in school quality funding, and critically persistent appraisal gaps between predominantly white and predominantly minority neighborhoods, even when controlling for property characteristics.
So modern data analysis has to contend with this legacy. It's not just about swapping race data for socioeconomic data.
Exactly. There's a real risk that modern predictive models, if not carefully designed and audited, could inadvertently reinforce those historic divisions. You need to actively incorporate layers of ethical considerations and look at more granular data like infrastructure investment patterns or generational migration flows to counteract potential biases baked into the historical data.
Okay, if we connect that historical data legacy to the bigger picture of systemic risk in housing finance, we can draw a pretty direct line to the subprime mortgage crisis of 2008.
Oh, absolutely. That crisis was a brutal wake-up call. It forced the realization that Wall Street institutions were packaging and selling frighteningly poor quality loans on a massive scale. Certain firms even became notorious for originating or packaging America's absolute worst home loans, and then, confusingly, sometimes betting against them.
Right, the complexity of how risk was transferred and who was betting on what was staggering. The data was deliberately obscured in many cases.
It was. Firms like, say, Deutsche Bank were known to be involved in selling some very poor quality loans packed into mortgage-backed securities. But then you had sophisticated investors, like certain hedge funds, who were using their own data analysis to see the rot underneath and actively bet against these securities.
Often using instruments like credit default swaps or CDS. Can we just clarify what a CDS is simply?
Sure. A credit default swap, CDS, is essentially an insurance contract, but it's traded like an asset itself. When you buy a CDS, you're paying a premium to get protection against the default of a specific bond or a package of loans, like those subprime mortgage bonds. If the underlying bond defaults, the seller of the CDS contract pays you the value of the bond. If the bond performs fine, the seller just keeps the premiums you paid.
So it's like buying insurance on someone else's house, hoping it burns down, but in the financial world.
Kind of, yeah. But the sources note an important nuance. Many of the big Wall Street firms buying CDS on subprime bonds weren't necessarily making an outright bet against the entire U.S. housing market. Often it was used as a hedge.
A hedge against what?
against their other massive portfolio holdings that were implicitly betting on U.S. real estate doing well, things like stocks of home builders, banks heavily involved in mortgages, other types of real estate bonds. So buying CDS on the riskiest subprime slice was a way to ensure their broader portfolio against a potential downturn in that specific vulnerable segment. They weren't betting the whole house would collapse, maybe just that the shakiest part of the foundation would crumble.
It's a very sophisticated risk management maneuver, then, based entirely on analyzing macro risk indicators and data that showed just how toxic those underlying subprime assets really were, long before the general public caught on.
Exactly. It was a data game at the highest levels.
Okay, speaking of macro influences, let's switch gears slightly to urban design and planning. The sources bring up Jane Jacobs and her powerful critique of the urban versus suburban density dynamic, which still seems to dictate a lot about development value today.
Yes, Jacobs's work is still incredibly relevant. She identified what she saw as a critical danger zone in urban planning, these in-between densities.
What does she mean by in between?
These are areas that are too dense for traditional, spread-out suburban life. You might still need a car for almost everything. Maybe sidewalks are inconsistent or non-existent. But at the same time, they lack the density and, crucially, the diversity required for vibrant city life. They don't have that critical mass of mixed-use development, shops, services, residences all jumbled together.
And her argument was that these areas.
A famous argument was that these in-between densities are, quote, fit generally for nothing but trouble. They lack the natural eyes on the street that provide safety and vitality in truly dense, mixed-use urban areas, but they also lack the privacy and green space of true suburbia. They fall into an awkward, often dysfunctional middle ground.
And her observation really challenges the prevalent American pattern of development, which influences property values significantly today. The U.S. model is often characterized by, well, very low residential density overall, right?
Overwhelmingly so. Plus, a very gradual density curve as you move out from city centers and historically relatively weak land use planning compared to some other countries.
This tendency towards low density is why, structurally, something like 2/3 of all dwelling units in the United States are fully detached single-family homes, each surrounded by its own private, often purely ornamental yard.
Exactly. And that pattern requires absolutely massive infrastructure spending per capita: roads, utilities, services spread over vast areas. This increases local tax burdens, which is itself a critical data point for investors to track when evaluating long-term market stability.
And that focus on separation, particularly separating where people live from where they work or shop, is also deeply embedded historically in the U.S. approach.
It is. Interestingly, while the concept of citywide zoning was actually a German invention, it was really Americans who embraced and developed the idea of using zoning to rigidly separate land uses, creating distinct residential zones, commercial zones, industrial zones.
Which is quite different from the pattern you often see in older European cities, where you might have shops or businesses on the ground floor and residences right above them in the same building.
Precisely. This American focus on strict separation of functions has fundamentally shaped our spatial distribution, our reliance on cars, and consequently, the underlying property values and development patterns we see today.
And this structural issue, this legacy of low-density, separated-use zoning, it ties directly into modern marketability challenges and opportunities, doesn't it? You hear a lot about demand for the missing middle housing.
Absolutely. The growing demand for things like duplexes, townhomes, small courtyard apartment buildings, that missing middle between single-family homes and large apartment complexes, is in many ways data reflecting a fatigue with that traditional low-density model, especially among younger buyers facing affordability issues or older buyers looking to downsize and people dealing with the high infrastructure and transportation costs associated with sprawl.
Okay, fascinating connection. Finally, let's bring it back down to the specific property level and look at architectural data as a direct valuation indicator. You're saying details of house styles can function as actual data points?
Yes, think of it as forensic real estate analysis. Specific architectural details can tell you a lot about a building's age, its authenticity, and crucially, its potential marketability premium based on style trends.
Give us an example.
Okay, here's one from the sources. The presence of paired windows, that's two windows, joined together vertically as a single unit. This detail is usually an instant clue that a house is a colonial revival or maybe a federal revival style, built likely in the late 19th or 20th century.
And not an original colonial or federal structure from the 18th century?
Correct. No original colonial or federal house ever used paired windows. Windows were always constructed and installed as single units back then. An experienced appraiser or a buyer specifically looking for true historical authenticity will spot that difference immediately.
So that single architectural detail becomes a data point. It determines whether the house commands a premium for being a genuine antique versus just a later revival style.
Exactly. It affects the perceived value and rarity. We also see specific historical housing trends becoming useful data points for modern valuation. The sources note, for instance, that the Greek revival style became almost a mania in the US in the mid-19th century.
Why Greek revival specifically?
It was heavily linked to the democratic ideals of the young nation, drawing parallels with ancient Greece. And the interesting data point here is the sheer volume and pervasiveness of it.
Right, the sources mentioned the American taste for Greek revival was so extreme that the style was used for literally every building type imaginable, from grand state capitals all the way down to, well, humble backyard privies.
That ubiquity, that volume, actually matters for valuation today. It tells the modern investor or appraiser that the style reached a peak saturation point and then subsequently declined in popularity. Analyzing that historical preference cycle helps you place a specific structure accurately within the market's current preference cycle for historical styles.
So an authentic, well-maintained Greek revival house today might command a premium because of its age, craftsmanship, and relative rarity now, but it won't be seen quite everywhere.
Unlike, say, the much more common colonial revival style from the 20th century, which generally doesn't carry the same historical cachet or scarcity value, architectural data, the style, the specific details, its historical context becomes another crucial layer in understanding and potentially maximizing the sale price, because it speaks directly to perceived quality, rarity, and desirability in the current market.
Okay, this has been a really comprehensive deep dive. We've covered a massive amount of ground and really confirms that the property market has decisively shifted, hasn't it?
Yeah.
Moving from that old world of intuition and local knowledge to one heavily reliant on systematized intelligence and big data.
Absolutely. We've looked at the immediate competitive advantages you can gain through prop tech, the rigorous discipline required to master financial formulas like cap rate and cash on cash, and importantly, those profound, long-tail structural legacies, historical and societal data that still influence value and risk today.
So the key takeaway for you, the listener, seems to be about mastering the process, right? Success in the modern property market demands getting comfortable with those financial formulas, adopting the accelerated systems that PropTech enables, which allows for that remote, data-driven investment, and critically, understanding how these deep historical patterns, from redlining maps to urban density choices, still translate into tangible risk and opportunity in today's market.
That sums it up well. It's about integrating all these data layers.
So what does this all really mean for the person listening right now who wants to gain that competitive edge? It sounds like even in an industry as historically volatile and relationship-driven as real estate, success is increasingly driven by meticulously tracked processes and disciplined measurement.
Absolutely. That's the core message. The concept of predictable stats and reliable conversion ratios, whether you're tracking leads converting to closed deals or your projected IRR versus your actual achieved IRR, it suggests that if you, as an investor, diligently track your efforts with measurable activities, that data truly acts as a reliable gas pedal for driving growth.
So success becomes less about getting lucky with one intuitive guess on a single property.
And much more about consistently identifying which systematic activities actually produce the desired result, finding what works through data, and then relentlessly scaling those effective activities. It's about building a reliable machine.
Which leads us to our final provocative thought for you to consider. In the face of this complex, data-rich market, perhaps the richest investor isn't necessarily the one who makes the single highest profit on one deal, but maybe the one who has the most meticulously tracked, repeatable, and reliable process. So, the question back to you is, how well are you measuring the systematic activities that lead to your desired results in your own endeavors?